Hey everybody, Brad Hesselberg, owner and co-founder of Sword and Shield Solutions and the Market Forge. Before we get started, I'd like to make it clear that I am a licensed financial advisor, but I'm not your advisor. This should never be seen as financial advice, simply for educational and entertainment purposes alone. Look, I want to start out with a question that most people think, but they rarely say out loud. Is staying the course, long term investing, actually good advice? Or is it just a polite way of advisors to tell people to not ask questions? Look, the reason this exists is that clients are not impatient. They see market shifts, they see changing environments, and they want to ask the question, is this current strategy still a good idea from when we initiated it? The truth is that long-term investing does work. It is a strong way to invest, but over time, it has slowly been misused as a permission slip to disengage. Okay, the edge is not about abandoning long-term thinking, but pairing ownership with awareness. And what do I mean by that? Like when we're investing, we're purchasing assets, right? And we've seen all the charts and all the, talk about Apple and Microsoft and Nvidia and how long-term investing really worked out for those folks. What I'm talking about is being aware of where we are in the cycle. Should we be buying assets long term right now, or is this more of a mid to short term type of investment? Because those things do exist. There's scenarios like we've seen in the last several years. The AI trade has really carried the overall market. If you were focused on financials or if you were focused on some other sectors, you probably underperformed the overall market, right? Because if you were paying attention, early cycle tends to be, larger cap, or because we were in a tightening cycle, you saw more assets go into large caps, safer assets, so to speak, which you see that a lot. But it depends on timing. And we're not talking about timing the market, but we're talking about understanding where we are in the market, where things are as far as cycles go, and when we're buying that asset, are we looking at a long-term investment instead of just assuming that it's always long-term? Okay. The truth is the clients are not impatient. Look, they sense change. We're all well aware of change. Markets change, policy, liquidity, they don't always stay the same. They're constantly changing, right? So we feel as investors that our portfolio should change with the times. Okay. So the differentiator is long-term investing is a good way to go about it. But understanding time frames and whether or not we should be holding certain assets long term, that's where it comes in. So a, if you're getting just a general, hey, I asked the question and the response is, don't worry about it, we're just holding long term. If that is a response for any sort of volatility or uncertainty in the markets, that's when the question mark arises is this just an easy one liner to tell clients when they're concerned? I think that is important context. Look, what we know is that compounding really does work. It is true, right? I don't want to get away from that ideology. Compounding does work. Behavioral discipline matters. Like when you're seeing an aggressive sell-off, in a lot of cases, that's not when we want to sell our positions. Okay, we want to understand that we should hold through the volatility, but if the markets are closer to highs than they are to the bottoms, is that when we start asking the question, hey, should we be taking profit? Should we be partially in cash? Should we be preparing for volatility? Those are the important questions that clients are asking, and I don't know that they always get that kind of response when it comes to what am I supposed to do with this portfolio instead of just hold long term. Okay, panic destroys long term outcomes, and we kind of shared that. if you in 2025 we saw the Trump tariff thing, if you had just sold while that was ongoing, that wouldn't have been the right move. Panic and fear will cause people to sell. That's where an advisor is very helpful, where they say, hey, we're going to go ahead and hold through this volatility. We expect this to correct itself. Okay, that's okay. That's smart investing. But when you identify that we're closer to highs, hey, the market's been pretty hot for 3 years. Do I still want to just be holding long term, or are there other strategies that we can take into place here? Those I think are very important questions that clients want to ask, but every time they ask it, the response tends to be, "Don't worry about it. Just buy and hold. It'll be fine." Um, Look, time is powerful, but it's not magic, right? There still needs to be structure and strategy when it comes to long-term investing. It does not override, incentives. It doesn't override regime change, which what I mean by that is changing in tax code, changing in interest rates, changing in presidency, changing in policy. Those will all impact how we look at long-term investments and whether or not our investment is still worthy of a long-term hold. Look, long-term investing is used to avoid addressing structural shifts, policy interventions, or valuation extremes. Like what I mentioned earlier, are we closer to the highs than we are the lows? Is it important to take profits on positions when that happens? Because I guarantee you, institutions are doing that. I know they are. That's how you get these aggressive sell-offs, because major buyers of people that bought when, you know, Meta or some other big position was much cheaper, right? They get to a certain extreme and they say, hey, this is where we're going to start taking profits. Shouldn't, as educated investors, we be doing the same thing? I think that's an important question to ask. Look, long term is not a strategy, it's a time horizon. From my perspective, you should have short, medium, and long term investments. And if you don't have those in separate buckets, it's certainly a question to ask, in my opinion, as to why not? Why don't we look at it from that perspective instead of just being very diversified across a bunch of different sectors and just holding those for years because we don't know that they're necessarily going to perform the way that we need them to, instead of just showing up in pockets when the cycle deems it appropriate. Okay? Look, rules change over time. The only constant in life is change. So if the world around us is changing, I think it's perfectly fair and a good thing to ask, is my portfolio changing with the times? And pretending that just long term will outdo everything, I think that's the wrong ideology. What are people really asking when they ask, is long term still a good investment? Like they're not asking for more activity. Okay, we're not day traders. We don't want to be day traders. We don't want to be swing traders. We want to be relevant, or I mean, we want to be aware of the environment that they're in and make decisions based off of that. That is what people are asking about. Look, they're asking, does my portfolio still reward the same behaviors that it did 20 or 30 years ago? Because there's a pretty good possibility that it's changed, that the world has changed. I mean, just look at us in the last 5-6 years, how much things have changed. Okay, your portfolio should look the same. Look, fear is rarely about markets alone. Okay, what I've recognized is if you have a small allocation to a highly risky asset, well, it's a small allocation. You're comfortable with it. It feels right to you. Fear is about sizing, not knowing the assets that you're holding, or not knowing enough about them. And again, looking at the world around you as it changes and not knowing if your portfolio is changing with it. Okay? It's about time, control, and optionality. People aren't asking for more activity. They're asking for more awareness from their advisor. Look, long-term ownership does not mean passive acceptance, where you just say, hey, I'm going to buy this asset and I'm just going to hold it forever and never look at it again. In some cases, that's worked. Apple, Microsoft, Nvidia, Tesla, there's a lot of great examples of that. But there's also a lot of great examples that go against that. You've got Blockbuster, Toys R Us, you've got Goldman Sachs, um, Credit Suisse. There's been a lot of different times where these major companies, which everybody thought were, top tier, gonna last forever, and they go belly up. If you weren't paying attention, you wouldn't know one way or the other. So we still want to be aware of what we're invested in. Does it still fit into a long-term framework? And is there changes that we need to make? Look, long-term ownership plus short and medium-term awareness, that is intentional investing. I'm going to say that again because I think that really pulls a lot of things together. Long-term ownership plus short and medium-term awareness. Okay, we are aware of our surroundings. We're aware of our strategies. That is an intentional investing. Nuance requires education. Education requires accountability. Okay? It is far easier to repeat slogans than to explain evolving systems. Okay? Simple advice scales way better than honest advice. Okay? If I'm just an average advisor and my response is simply, hey, just buy and hold, it'll be fine, that tells me that they're not aware of market conditions, and it's more of just a business as opposed to something that they're really passionate or excited about. Okay. I think how to think about this practically, right? So we've talked about a lot of different things about, hey, does long-term investing still work? And I hope what you get from this is that long-term investing does still work, but you need to be aware of your portfolio, and more importantly, you need to be aware of if your advisor is aware of these things and taking them into account. Okay, so we want to observe before reacting. Okay, we don't want to just panic sell. We don't want to do that. That's where an advisor is really good, where they will make sure that you're not going to sell in a panic. That's very important. Okay, but what we also need to take into account is we adjust exposure instead of panicking. Okay, if you're starting to feel like, hey, this run has gone on pretty aggressively, I've got some really good gains in my portfolio, and I'm concerned where the markets are heading right now. Okay, we're aware of our surroundings. Now we have to ask ourselves, do we have to adjust for exposure, which is fair to ask. Okay, now we're not talking about predicting markets. I would never recommend trying to predict markets. Time in the market is better than timing the market, but being aware of your surroundings is still paramount. And what I mean by that is, here, let's just take an example, right? Everybody quotes Warren Buffett, right? He's the greatest investor of all time. He's really figured this whole thing out, identified companies in their infancy and invested. So he really tends to know what he's doing. He's been mostly cash for the last 2 years while we've had a pretty aggressive bull run. Is he timing the market? No, he's not timing the market. He's looking for certain signals that tell him now is the time to get in. That's totally different. Okay, he's not timing. He's using certain indicators, he's using certain fundamentals, he's looking at different things, and then when these things line up and identify, hey, it's a good time to invest, that's when he invests. There's a clear difference between the two. And that kind of goes into the next topic, is we respect cycles without predicting them. Okay? So cycles are usually anchored to interest rates, business cycles, liquidity. Those things tend to go heavy into cycles, right? So real easy way to look at that is, if interest rates are high, then money is more expensive to borrow and you don't get as much business expansion as you would typically get in a low interest rate environment. Now, that doesn't mean that you buy everything when it's low and you sell everything when it's high. That's not what I'm saying. But these are things that you need to be aware of that will certainly help your portfolio improve or help you understand what can perform well and what can perform poorly, and how we need to be allocated in those kinds of environments. It's just one example. Okay. Most importantly, we want to build flexibility into the plan. One of the things that I like to make sure of is, do we have cash or dry powder? Or it could just be sitting in a money market fund. Because if we have cash available, that is a position. Right? Some people will say, hey, we want to be fully invested. Okay, we don't want to have any cash. Cash doesn't pay. You know what? That's not necessarily true. If you look at it from a different perspective, okay, if we let's go back to the Trump tariff thing in 2025, just because it just happened, right? It's in people's memory still. Okay, if we were 100% allocated in that time frame while we watched our assets drop 20, 30+% over just a couple of weeks, that's scary. Like that's when you panic. That's when you're asking questions like, "Oh, is this what we should be doing? Should we sell? Like, what should we do?" But if we're in that same situation and we're, let's say, 70% allocated and we've got 30% in cash, now we're kind of excited, right? Yeah, our portfolio is struggling here in the short term, but when we feel things start to normalize, we can buy assets at a cheaper price, which will lower our cost basis, which is great, and it will also give us more upside potential. Okay, I think that's very important to understand when investing, is that cash is a position. Okay. The goal is not constant action. We don't want to be in and out, in and out, in and out. It's not what I'm talking about. We want to avoid that. The goal is to avoid blind spots. So like just what I pointed out. Cash is a position. Cash helps us position and avoid being in blind spots. I have zero interest in predicting the market. You'll go nuts. It's impossible. But what I do is prepare for different outcomes, different scenarios. Then I collect data or fundamentals, not just on assets, but the environment around them. I also do a fair amount of technical analysis because I believe that will play heavily into whether or not this asset is something that we should be getting into and what your overall markets look like. And I actually did a video yesterday that talks about some of the things that I'm looking at and how I feel about this environment currently. So if I collect data and I have more data so that I can understand what our realm of possibilities are, I can use that information in an investing environment. I think it's incredibly important to take that into account. Look, we want to follow some simple principles when investing. Are we buying real assets? And what I mean by that, are they assets that fit into the current dynamic of the market? AI is a simple one. Is AI important to be investing in? You bet. Is it a growing market? 100%. Are we in an AI bubble? Don't know. Okay, AI has moved aggressively in the last couple of years. So is it a good asset class? Yes, it is. Okay, but are there other asset classes that have more future potential because AI is already run? That's something to take into account, right? But we want to buy real assets that are really impacting the world that we're in. You've seen the aggressive purchasing of precious metals like gold and silver. People are buying real assets because of the environment that we're in. You're in, the kind of the general consensus is we're looking at currency debasement across the world. Countries are printing money. The U.S. is not currently, but we are not in tightening anymore. So we're one step closer to turning on the money printer. So the world sees that. So they're buying gold and silver and things like that. So those are real assets, things to consider. Respect cycles. All right. If you were paying attention when they started raising interest rates, that would have been a smart time to say, hey, is my portfolio built for a rising interest rate environment? If you remember, a lot of the assets that had performed really well, including things like Bitcoin, got absolutely demolished. Why is that? Well, when interest rates go up, that makes money more expensive. It impacts the bond market, which we saw significantly. Bond market got wiped out in 2022 because they aggressively raised interest rates. Current bonds had no value. Future bonds is where people wanted to be. So they sold their bonds and you saw a massive price decline that you haven't seen in years. if you were aware of these cycles and these things that engage cycles, you might have had a bit of an edge as opposed to someone that's just sitting on their hands and ignoring what's going on. Adjust exposure over time. I kind of already touched on this, but people think that it's smartest to get into the market when everything is going up. No, it's a double-edged sword that way. Yes, everything's going up, but you have to understand price dynamics. You have to understand how the market moves. When you get strong moves to the upside, that's likely means that institutions, whales, or people that have large are able to buy large baskets of stocks. When it's getting pushed up, that's usually when they're selling positions, and they're usually selling it to retail. Like, that's just how it works, right? So adjust exposure as time goes on. You want to be early in the cycle, not late. Okay? You want to be more heavy exposure early in a cycle when it's scary. When people are like, "Hey, we're in a recession. Hey, everything looks really, really bad." That's usually some of the best times to get in. Now, again, that's not financial advice. That's just being aware of the situation. Warren Buffett said, "Hey, when there's blood in the streets, even if it's yours, that's when you should be buying. Buy fear, sell greed." Okay, that's what institutions do. It's okay to have a similar mindset. Okay, stay flexible. Cash is a position. I think that should come clear through this video. Cash is a position. Okay, make sure that you have the ability to stay flexible. Make sure you have short-term, mid-term assets that you're willing to sell, take a profit, sit in cash, and wait for things to get cheaper, or wait for the next sector to do really well. And you can certainly gauge these things by watching technicals and fundamentals. Being patient does not mean being passive. Okay, I want you to take that away from here. Being patient does not mean being patient. It's okay to ask if long-term still makes sense in different asset classes. Those are important questions, and if you're asking those questions and the advice is consistently just buy and hold, don't worry about it, and you're not happy with that, then maybe it's time to ask some of these other questions to somebody else and see what their response might be. But I want to thank all of you for watching this show and watching this channel. If you found it useful, do me a favor, subscribe, at least give me a like. It really helps grow the channel. I've got a couple of things that I'm going to put in the description below. Like I said, I am a financial advisor. I have what I deem to be a pretty unique offer. It'll be in the link below. Feel free to take a look at that if you're looking for financial advice or a different kind of advice or a second opinion. And then lastly, I've put together a PDF. I put a lot of time and effort into it. I'm going to link that below in the description as well. It will help you understand how I look at markets, how I build framework, how to understand where we are in the market. It's not a crystal ball. It's not going to tell you exactly what to do and when to do it, but it will at least help expand your thinking on how we look at markets. And if you enjoy that, please let me know. But thanks for showing up, and enjoy the rest of your day. Take care.